I want to briefly introduce the concept of enterprise risk management. Now, this is the process of identifying and assessing risks and seeking to mitigate potential damage to the firm. Modern enterprise risk management views risks in the context of the entire company. So you shouldn't just look at one division or one product, but you should look at the entire portfolio of the company. Many companies have found that this is so important, they've created a new C-level executive position known as a Chief Risk Officer. So they're up there with the Chief Financial Officer, Chief Information Officer, Chief Investment Officer, things like that. What's the process? Well, we want to identify the specific types of risk that will impact the firm. Keep in mind that some risks may offset each other, so it's important to look at the firm as a portfolio of risks and not just look at each risk separately. For example, take an oil producer that also has gasoline refining facilities. Higher oil prices help the oil production business, but hurt the gasoline refining business. You must also look at the cost of managing the risk relative to the benefit derived. You don't necessarily want to get rid of all the risk because it may be too costly to do so. Risk profiles turn out to be a useful tool for determining the relative impact of different types of risk, and we'll talk about that in a moment. Basically, risks fall into four types. Hazard risks, which involve damage done by outside forces such as natural disasters, theft, and lawsuits. Financial risks arise from such things as adverse exchange rate changes, commodity price fluctuations, and interest rate movements. And then there are more management-oriented risks. Operational risks encompass impairments or disruptions in operations from a wide variety of business-related sources, including human resources, product development, distribution, and marketing, and supply chain management. And finally, strategic risks include large-scale issues such as competition, changing customer needs, social and demographic changes, regulatory and political trends, and technological innovation. Now, in the videos I'm doing here, I'm going to focus on hazard risk and, more importantly, financial risk. We'll save the operational risk and strategic risks for the management people. One simple way to deal with risk is simply to buy insurance. And it's the most widely used risk management tool. And it's usually used to protect against hazard risks, fire, theft, earthquake, that sort of thing. And when you think about buying insurance, it's really a net present value question, right? Do the benefits outweigh the costs? If they don't, then it may be better just to accept the risk. Turns out that large firms often self-insure against less costly risks. So they just set aside money to pay in the event of a loss rather than purchasing insurance. Managing financial risk. While firms often purchase insurance for hazard risks, financial risks are often reduced through the concept of hedging. Hedging, or sometimes known as immunization, is a process by which the firm reduces exposure to price or rate fluctuations. And they usually do this using some sort of derivative securities. Those would be things like futures, options, and swaps. Before you get into managing the risk, one thing that's really useful is to create a risk profile. And it's a basic tool for identifying and measuring exposure to risk. It's a graph showing the relationship between changes in price versus changes in firm value. And it turns out the steeper the slope of the risk profile, the greater the exposure and the greater the need to manage the risk. So let's take a look at a picture here. What we have here is a picture for the risk profile for an oil seller. Down here we have the change in the price of oil, and here we have the change in value. And you have this line here. You can see that as the price of oil goes up, the value goes up. So that's a good thing. But as the price of oil goes down, the value of the firm here goes down. It hurts the firm. So you're going to want to find a way, or this firm is going to want to find a way to reduce this downside risk or to eliminate risk altogether. On the opposite end, we have the oil buyer. This is the case where increasing oil prices cause a loss in value. Decreasing oil prices cause a gain in value. And here I've drawn this, as was the case in the previous graph, fairly steeply, so there's quite a bit of risk. If I'd drawn this more, with a flatter risk profile, there would be less sensitivity to a change in value when oil prices change. So in terms of reducing the risk, what we want to do is oftentimes we want to hedge. And the goal of hedging is to lessen the slope of the risk profile. In fact, if you can flatten it out totally and make it horizontal, you've eliminated all the risk. Now, you want to keep in mind that hedging will not normally reduce risk completely. For most situations, only price risk can be hedged, not quantity risk. So you can worry about prices changing, but it's very difficult to hedge, for example, people buying less of your product. And in some cases, you may not want to reduce risk completely because you miss out on the upside potential. So instead of creating a horizontal risk profile, so essentially when price changes, nothing happens to the value of the firm, you may want a bit of a slope. You just don't want it to be quite as steep as it was before. Financial risk, or the risk of price fluctuation, has two components. Short-term exposure, sometimes known as transactions exposure, arises from the need to buy or sell at uncertain prices or rates in the near future. And these can often be hedged with a variety of tools such as derivatives, futures, or options. And I will discuss how to do that in a separate video. Long-run exposure, which sometimes is referred to as economic exposure, arises from permanent changes in prices or other economic fundamentals. These are almost impossible to hedge, and it requires the firm to be flexible and to adapt to permanent changes in the business climate. So this is probably more of a strategy type thing than a financial type thing. So in two other videos, I will show you how to hedge using futures and forward contracts, and I will also show you how to do this with options.